Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending May 12th, 2017. We're wrapping up earnings. Q1 earnings are coming to a close. We got, a couple more companies to go through another week or so as they dribble through. But we've had about a little over 70%, 72% through the end of this week, S&P companies reporting. And we've had a good deal of them beat their profit forecast. Overall, it looks like the S&P is set to grow about 15% for Q1. Earnings per share for the rest of this year are looking to grow by 11%. And usually what happens is then from Q1 through to Q4, most analysts start revising down projected earnings for, upcoming quarters. But in this year doesn't seem to be the case. Now, valuations, excuse me, before the election, and we've had that Trump bump, was around 15.9, slightly under 16. And now we're getting a current valuation. It's trading at about 18.1 times earnings. So, clearly we're getting a couple of percentage point bump because of Trump and potential fiscal policies that this guy is going to put forward. But we're getting to a point where that's pretty much done. The markets are now in this slow grind mode where they need fiscal policy or they need some kind of a stimulus to really get the markets moving higher. And as I've been telling our members for the past 2 or 3 months, the percentage of companies that are above their 50 EMA versus below their 50 EMA moving average, it seems to be going down. So the breadth of the market is getting more shallow as we go higher, which is not good, which would all portend a potential drawdown in the markets. Now, as I've been working with my members in our user group, I've been telling everybody that we are in a dip mode, buy the dip, meaning we've been in this dip and we can expect to move higher. And that's kind of what we did. If you look at the chart here, I've got as I always kick off these weekly roundups, this is the S&P 500 E-mini futures. You can see here that within this box here, I was talking about a dip type of environment, and that's what we've done. We followed this trend line down, and then we had this break from here to here. We gapped up in over 9 hours on Sunday night a couple of weeks ago when Macron was going to be the runoff finalist against Le Pen, and then of course Macron won, so that took a lot of fear out of the European markets. Now there's trades that our members are doing where we're playing Europe and we're playing currencies based on that, and they're working out well, and we're going to continue to do that. And by the way, if you're not in our user group, I would highly encourage you to come in. And for those of you members in Singapore, or all of you that are watching my weekly update and you're in Singapore, stand by, because I will be there probably March or April of next year. We're going to do a nice seminar at probably the Mandarin or the Peninsula Hotel there, a real nice hotel. We'll do a seminar there, so I think all of you guys are going to, and women out there, are going to really enjoy it. But if you look at the markets here, you can see that we've had this break to the upside, and then we made this peak here, and now we're sitting in a situation where after we made the 2403.75 all-time highs, now we're having just a little bit of a pullback here. Again, we're still in a buy on the dip mode. However, you can see from this peak right here to this peak here, there was no bearish divergence, what we call a bed. There was no bed set up here, so that meant any pullback right like here, which is what we did get, was just a buy on the dip. Now we got an official buy signal that following Monday from that vote, and as you see, we made a new high here from this high here, and then now we've got that divergence setting up. And now this divergence is what we call our poor man's bearish divergence, right? Meaning it's not as rich as a traditional bearish divergence, which is what we look at right now. In this area here, there was absolutely zero bearish divergence. Here, we got the poor man's bed. And why do I call it the poor man's bed? Well, the poor man's bearish divergence, we've got this right here, which basically tells us that we're in a consolidation mode in the markets, okay? And that weakens the strength or lack thereof of divergences that you'll see in the MACD, okay? Now, even though we've got that, that does mean that there's going to be a lot of downward pressure until this divergence is worked off. But there's also a lot of upward pressure because the markets are doing fairly well. We just had a few weeks ago the unemployment. It fell to 4.4%. This past Friday, we got inflation, which shows that it's under control. The core CPI is up to about 1.9%. So it's still below the 2% number that the Feds are looking at. But the markets, the 30-day Fed fund futures is forecasting a little over 85–90% of a rate hike in June. But come the remaining part of the year, they're only saying, according to the Fed fund futures, a forecast of about 47.5% rate hike. One more rate hike after this June. So the markets right now do not have priced in. They've got one rate hike priced in and the 50-50 probability of another, just because inflation is under control. So the markets are in this equilibrium right now, as shown by this right here, which then in turn drives volatility down to lows we haven't seen since the early 2000s, over a decade or so. Vol is just extremely low. In fact, last week it fell below 10. It was like 9.8, 9.7, something really ridiculous, low number like that, because we've just got this compression here. Now, this will not last, as nothing lasts in the markets. Environments always change. But right now, this is the environment we're in. Now, our members, we're getting ready to take off a couple of trades that we put on every month, and they've worked out very well for us. And we do these in the indexes, and we also do them in the commodities. And we've done them in a couple of commodities, and both of these are coming off some of them are coming off next week and the week after. And that's in our secret trader. So these are just trades that we like to do, whether the vol is high or the vol is low. We like doing these trades. Excuse me. So you can see where we're sitting right now. The market is still susceptible to a little bit of a dip here. You can see I would view the 50 EMA right around 2361 as kind of an area of support for us. And if we look at the weakest sector or the index, that would be the Russell. You can see here with the Russell, again, we're sitting right on the 50 EMA for the Russell. The 50 EMA and the Russell are almost right on top of each other, okay? 1380. 77 is the 50 EMA, and then the Russell finished at 1380.60, so slightly below it. And I think it would not take very much to move the Russell back below the 2017 open price and actually move into the red for the year. So when you really think about it, if we step out a little bit, all the Russell is doing from the election with Trump, down there, the lows, right? That was also we went into the red for 2016 in the last part of the year. We had this huge move up in price, right? I mean, we moved up like that, and then all we've done is sit. So this big move up in the Russell, and then just a very long sideways pattern for the next 4 or 5 months, right? I mean, from November, December, January, February, March, April, I mean, 5 or 6 months, we've gone nowhere with the Russell. That's why the high price and the low price for 2017 is relatively tight for the rut. Now, remember what the rut is composed of: small and mid-cap stocks, which tend to have more earnings U.S.-based versus international European-based. This is another reason why I've had our folks in our secret trader part of our user group. We're starting to take plays that are more internationally oriented, whether it's emerging markets or European-based, because I think the U.S., keep in mind, since 2008, 2009, which is when we hit the lows, March 9th or March 6th, 2009. Those were the lows. The U.S. indexes have moved up over a couple of 100%, but the European index has only moved up about 100% or so. So we've almost moved double. We're well ahead of our 2007 highs, but Europe is not. So there's going to be some opportunities on a relative basis compared to the U.S. index with Europe. And this is an area where we're focusing, but this chart kind of says it all, right? The Russell has gone nowhere right now. And I do expect other markets to really show forth. Now, I talked about the breadth of the market. If you look at the NASDAQ right here, I mean, heck, the NASDAQ on Friday, this past Friday, made all-time highs, okay? This green dashed line down here was the location of the dot-com bubble highs in the year 2000, and then it also was around where we opened 2017. So you can see the width here. NASDAQ's been on fire. And if you can look here, there's absolutely zero. I mean, there is zero bearish divergence. Doesn't mean we can't fall. It just means that any move down here more than likely is going to be a dip, and it's going to be a buying opportunity for folks that know how to find it and take it back to the upside again, at least for the near term. Now, I know a lot of analysts have been talking about a grind higher, and I would agree with them, but there are a few analysts, and I would agree with them as well, that say we can have a kind of a slow, steady, quiet summer with a grinding mode, range bound, maybe slightly higher, slightly lower, a little bit going nowhere. But then I can see a little bit of a further pullback in the fall time where we traditionally in the SPX get a bump. I can see a traditional element where we fall 5 to 8% in Q4. But I will keep our members in tune with this. But you can see NASDAQ is just on fire. I mean, literally on fire. Now, this goes along with the breadth of the market because there's only about 4 or 5 stocks. You know, Facebook, Amazon, Netflix, Microsoft, Google. These stocks account for a large percent of the upswing that we've seen in the indexes, but there's only about a handful of stocks, right? And there was a stat that came out last month that showed that those stocks accounted for over 50% of the gain in the markets. So this basically does tend to show that if these stocks start to falter a little bit, the rest of the markets, there's just not enough strength there to hold it up. So we'll get a little bit of a further dip. I am not in the, I do not believe, at least through the summer months, we're going to just automatically go into this kind of freakish free fall. But I do believe we could stay in a dip, and I define a dip as less than 10% of the pullback. And then a correction is officially defined as more than a 10%. Up to 20%, and then a bear market is officially defined as a 20% from the highs. So I still believe we're going to stay within that 10% dip mode. I don't think we've had a dip more than 3 or 4% anyway, except any index, except for maybe the Russell. So we're going to watch this very closely. Now, if we look at the volatility, because I talked about vol being very low, extremely low with the compression up and down, you can see here. And it's just truly amazing. If we look at the lows for vol, 9.56 that we had in the lows and volatility made on March 9th, 9.56. Folks, that is extremely low. And right at that point, around that point, I was telling our members to pick up some long volatility. We did it in the volatility futures as well as VXX calls. And you got to know how and why VX moves as it does to be able to accurately predict, not predict, that's the wrong term, but accurately pick the best strikes where you have a better chance of succeeding with VXX calls. Because trading volatility can be very difficult and very confusing to folks that don't understand it. And what happens is most folks lose. So we're in zone 1, which is the green zone, meaning very low volatility. So our option strategies, our strikes and things change a little bit as we change colored zones. So that is the volatility. Now, if we come over here and we look at bonds, because bonds is also a proxy of risk versus risk on versus risk off, you can see bonds moved almost a full handle higher after the inflation, because it showed there's not as much inflation, right? And that tended to show that the Feds are not going to be pressured to raise the rates 3 times this year, because Rosengren, the Boston Fed president, came out and said, hey, you know, I think we should raise the rates 3 times. And I think we should reduce the balance sheet at the same time. But the CPI data kind of gave them a reprieve. You can see where the bond market moved up strong after the CPI data. In fact, if we come into the 15-minute chart, you can see how bonds leading up to the 8:30 CPI data, you can see this was before 8:30, and then after the CPI data came out, bond market just took off, right? It just a freight train back up. Why? Because it was under expectations from a is there more inflation or less inflation, which meant less inflation tends to take the pressure off the Feds to raise the rates, which tends to move the rates lower and bonds higher. Now, eventually, this too will move down. I'm hoping that bonds moves up even higher than this because there's nothing more I would like to do than short bonds. But you can see this pattern here, as I've talked about before, could be one of these 3, 4, 5 patterns where we do one of those traditional Elliott wave patterns where we see it move like this, okay? And on these Elliott wave pattern moves, that would suggest if bonds does make this move, I'm not saying it will, but if it does, that would then move equity prices lower. Now, you know, if we move back up above this shaded zone, then that's probably what we're going to get. The odds favor bonds moving higher. Bonds are going to stay higher, interest rates lower than people think, at least for the short term. Okay, we almost came down and hit my target down here, and then we moved off of our target right here with the bonds. So, and then currencies. I love the euro. You can see here with the euro. This is a classic uptrend. Granted, it's very choppy, right? It's a very choppy uptrend, but you can just say we're making higher highs and higher lows, right? And in fact, this past Friday, or just a few days ago, we made a higher high, you know, at 110.36. We pulled back just a little bit. We're sitting on the 200 EMA right here, that colored line, and we seem to be holding it quite nicely. Should that break, we'll probably come back down in this area here. Remember, the euro gapped higher once Macron was clearly going to win the French election, so that took a little bit of risk off. And you can see here there's absolutely zero bearish divergence. And what do I say when there's zero bearish divergence? Any move lower is merely a dip, and it should be bought to expect the price action to go higher. And like I said, you can draw the trend lines here as a channel, higher highs, higher lows. That's a classic definition of a trend. And we're sitting right in this area here. So that doesn't mean we can't chop a little bit, but overall it's going to do one of these kind of numbers, I believe, as we go through the end of the year. Now you may be thinking, what in the heck? I don't get it, because if they're talking about raising the interest rates, here's the US dollar. Why in the heck would the US dollar be going lower while other currencies are going higher? It doesn't make sense, especially if the Feds are going to raise the rates. Well, it's very simple if you understand the correlations and the interactions in the currency market and the world's global debt market. I'm not going to go through all that detail here. Our members hear it from me all the time, and you become a better currency trader for it. But you can see here that, you know, the dollar is in a classic lower low, lower high kind of environment. And, you know, the one thing I will say here for just our general audience on the weekly roundup is that the dollar is really not the dollar. It's the dollar index. So the dollar index doesn't move independent of the other currencies. It moves based on what the other currencies are doing. So if the other currencies are getting stronger that make up the dollar index, the dollar's going to get weaker, okay? And that would be primarily the euro, which makes up over 57, 58% of the value of the dollar index. And then you've got some of the other currencies like the British pound, the Swiss franc, the yen, that kind of go into factoring in the value of the dollar. And I do believe that there's any upside here in the dollar, and if it is met and coming back down, then we're going to continue this kind of slow degradation of the dollar. Meanwhile, the euro is, as you can see, just the opposite. Now, the British pound Came down a little bit based on the Bank of England decision not to raise rates. They're going to let the economy run a little bit hot. But I do believe longer term the British pound is going to be a great play to the upside. Okay, there is absolutely no bearish divergence. You know, when you get the high and the high here and you get a high and a higher high here, folks, that's not a bet at all. So that means any dip here is probably going to be bought and we're going to move back higher again. So I'm waiting for a dip to look at this again, but I like the British pound. And of course, if we look at gold, gold finished up just a little bit because it likes the idea of no interest rates near term, or at least the lack thereof of longer term rates. So that moved the gold up. But I will tell you one thing. I think gold is going to go lower. If you look at the 50 and 200 EMA cross, you don't see very often the crosses happen that close together. Normally they're spaced further apart. Why? Because the 50 EMA and the 200 EMA are such lagging indexes that the market's really got to reverse hard to have them cross in the opposite direction again. And that's what we got. And I was expecting gold to come down into this area right here. Now we're getting a 3-leg, which means we could get a bull trap. We run up. You can see the 200 EMA is now flat. The 50 EMA is starting to get some separation from the 200 EMA. So we could see gold move up into that area. If it does and it rolls back over, then the odds of taking out that prior pivot low are very strong, and then we'll find ourselves back down in here again. There is absolutely zero bullish divergence, right? So that means, again, any move higher is probably the odds favor a sell the rally kind of mode, right? Just like we're in the buy the dip mode right now in the indexes. That's gold. If we look at oil, now oil's been another one we've been having some great successful trades in. Oil is just, I laugh, I said this last weekend. Goldman Sachs came out and said by the end of the year, oil is going to be up in the low to mid 60s, depending on whether it's Brent or WTI, West Texas Intermediate crude. As soon as they said that, what did oil do? Straight down. I've always laughed at Goldman Sachs 6-month and 1-year forecasts. They're almost always wrong. Their last most famous blunder was in 2008 when they came out and oil was about $145, $148 a barrel, and they said we can see oil. And this is in the summer months now. And they said they can see oil at $200 a barrel. And what did it do? It fell all the way down to about $32 a barrel. This was one of the best trades of my life. I took the opposite side of the table of that Goldman Sachs call. Thank you, Goldman. Now, they came right here. We're not quite in the middle of the summer, right? We were at the end of April. Oil looked like it was, you know, going up. What did they do? Well, it's going to go up a lot more. And as soon as they said it, we came down and actually made a new 2017 low, right? So now oil is getting a bounce right here. What we got to watch for is this a bull trap or is it a sell the rally? Right now, you can see that there is a very minor bullish divergence. So that kind of makes this a little bit more iffy than a normal sell the rally kind of mode. You can see the convergence of the 50 and the 200 probably in this area right here. So I think there's a lot of overhead resistance around this 49.20 area, 49.25. If we can punch through it, have a retest, support, and then move higher, that'll be a more of a bullish sign. If we fall, then we're probably going to come down and challenge these again. Now, intermixed with all of this is the idea that the OPEC, I believe they're going to meet on May the 25th, and they're looking at possibly cutting production even more. That is going to be very difficult for them to do, to get all those cats in the same bag. It's going to be very difficult. So I think overall the pressure is still going to be to the downside in oil. Anything that moves oil up is going to be falsely driven by OPEC, at least near term. And there's some trades I'm going to be talking to our members about in the ag market, not in the meat market, although we're getting a nice move in meat. We did some trades in the softs in orange juice and sugar. We're standing down right now, but we made great money in some of those trades. We'll be looking at them in another couple of months. More in the agricultural market, there's going to be some things in that as well. All right, everybody, have a really great weekend. As a reminder, tomorrow's Mother's Day, so make sure you take care of your special mom in your life. Otherwise, have a great one. Members, I will see you Sunday night. Non-members, I highly encourage you to come in and check us out. For those of you that are in the Singapore area, stay tuned. More will be coming out on that in the coming months. Take care, everybody. Ciao.